Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Tuesday the 19th of March 2019. I'm Darren Sinden and you can follow me throughout the day on Twitter by using @ds_Pepperstone. Right, let's kick off with a look at the overnight changes and price moves to be aware of. And first of all, let's just say that it was a pretty quiet session as far as the world's global foreign exchanges were concerned. There were 1 or 2 points of note, for instance, the British pound adding to its gains against the US dollar to trade with a 132.68 handle shortly before we went live with the video. That's perhaps surprising for reasons we'll come to momentarily. The Japanese yen was also on the front foot, adding 0.14% to its gains against the US dollar to trade at 111.27. Dollar index for its part largely unchanged on the session, easier for choice, down 0.08%, and the South African rand was also able to take some money off of the US dollar, gaining by 0.19% after a recent slide versus the US currency. Okay, what's on the calendar? Events that may move the markets today. A pretty compact calendar, though points of interest on it nonetheless. We've already had house price index data for the fourth quarter 2018 out of the Australian economy, and that showed a bigger than anticipated drop, and that will be a bit of another headache, shall we say, for the RBA to consider. Speaking of the RBA, they've also released their meeting minutes from their last round of interest rate talks. At 9:30 GMT, we will have unemployment and average earnings data out of the UK, probably the pick of the day's macro data. The unemployment data for the most part for January, though we do have a claimant count number for February in the mix there. At 10 AM, we'll have the ZEW survey data out of Germany, and that's both for economic sentiment and current situation. Always very interesting to take a look at what the Germany economy watchers are thinking about the state of play now and looking forward in the German economy. Also at 10 AM, we'll have labour cost data from Q4 out of the Eurozone, and at the same time, ZEW survey data for the whole of the Eurozone, and in particular the economic sentiment number for March. We pause then until 1400, crossing over the Atlantic to the United States for factory orders data for the month of January. And then a longer pause until 23:50, in fact, this evening, when we'll have the release of the Bank of Japan's monetary policy meeting minutes, the detailed account of its last interest rate meeting last week. Okay then, breaking news and comment that's caught my eye overnight. And first of all, House of Commons Speaker Mr John Bercow has ruled that Theresa May cannot represent her Brexit bill again without meaningful change to the draft, creating an 11th hour hurdle for the government's plans. Really, at this late stage, it's very difficult to see what the government can do in a limited timescale to manoeuvre around this. Can it change the wording of Theresa May's Brexit bill, or can it in some way suspend and restart Parliament and reset the clock? It all remains to be seen, but it's a very surprising turn of events, and hence my surprise at the continued strength of sterling. French regulators have told the country's banks to add to their reserves as credit growth in the country may be moving too fast for the current levels of provision. That's an interesting story, isn't it? Because we tend to think of the EU economy as slowing down, and yet in France credit growth is growing, which suggests that there's increased demand within the country. So sort of a two-way pull on the French economy there, perhaps, on a story that we'll no doubt return to in the coming months. Staying with banking, ECB banking supervisor Andrea Enria criticised the creation of national banking champions, suggesting that the central bank may clash with Berlin over the planned merger of Deutsche and Commerzbank, and I'm sure that's a story that we'll be returning to again over the coming months as well. Okay then, food for thought and something to take away with you into the trading day and beyond, and why not think about this? As US equities reached new 4-month highs last night, there are signs that the markets are becoming complacent once more, and are once again relying on central banks to solve their issues for them. Volatility indices across various asset classes have fallen once again, despite a challenging political and macroeconomic background. I don't think we need to list off too many issues, but obviously trade talks with China, the uncertainty around Brexit, the slowing European economy, etc., etc. It seems strange that volatility indices should be moving lower again, but you can clearly see they are. They spiked into the end of 2018. But ever since we turned the corner into the new year, they've been drifting lower again. I think that's probably a sign of complacency, as I've said, and I think we should be on the watch for well, for a change, for a break in that complacent attitude, or something that kicks the market back into life. Okay, it's risk warning time. Please do take a moment to read this risk warning, because trading CFDs and foreign exchange on margin can be a risky business. If you're in any doubt about those risks or the suitability of leveraged products for you, then please do contact your Pepperstone account representative. And as I say, please do take the time to read this risk warning thoroughly. Thank you for your time today.